Good afternoon, ladies and gentlemen. A very warm welcome to the first ever webinar by DGTS on the indirect tax proposals in the budget 2022-23. I hope I am audible to all.
Yes, sir.
Yes, sir, you are audible.
Yes, sir. You are audible.
Thank you. As a young assistant commissioner, I wondered what the group at Vigyan Bhavan would be discussing. As some of you may recall that during those days, the post-budget discussions used to take place in the Vigyan Bhavan. And I wished if I could be a part of those presentations. Looking back on those days, today, I feel privileged to welcome the speakers of the day, Mr. Vivek Johri, Chairman CBIC and Special Secretary to Government of India, Mr. Ganesh Dutt Lohani, Joint Secretary, Tax Research Unit, Mr. Sanjay Mangal, Principal Commissioner, GST Policy. I would also like to welcome the distinguished panelists comprising of Mr. Pramod Kumar, Director General of Performance Management and also of the Taxpayer Services, Mr. Uday Pimprikar, Chairman CII GST and Indirect Taxes Group, Mr. Bimal Jain, Chair of the Indirect Tax Committee, PSD Chamber of Commerce and Industry, and Mr. P. Rajendra Kumar, Chairman Indirect Tax Committee of ICI. And I am Dr. Rajesh Kumar Verma, 1997 batch officer, currently working as Additional Director General, DGTS Mumbai, and I am the moderator for the program today. For a smooth conduct of the program, everyone is requested to kindly keep the mic on the mute mode. And of course, you may put up all the questions you raised to ask in the chat box. We'll take them all. We have seen, heard, and a fair number amongst us have even gone through the budget proposals in detail. Well, one can talk of the impact on the SEZ, the changes in the gems and jewelry sector, the removal of the exemptions, the reduction of duties on the various imports, the canon judgment, and so on. But today's webinar is much more. It's much more. Really. The trinity of orators for the day are at the helm of affairs in the budget exercise, which address the participants. Thereafter, the expert panelists would speak out and it would end with a question and answer session. When we listen to persons of their stature, we realize what goes into the making of a budget. Why and how a particular provision has been inserted or deleted, and where we are heading to. I'm sure hearing them would be like enjoy the symphony of Mozart or being left spellbound by a painting of Picasso. Now I'd like to introduce Mr. Vivek Johri. He's a 1985 batch officer and was conferred the Best Probationer Award in his batch in 1987. Request you to kindly not open your mic, please. Thank you. He was conferred the Best Probationer Award in his batch in 1987 and the Presidential Award for Meritorious Service in the year 2000. He holds a degree in economics from the University of Delhi and an MBA from Swinburne University of Technology, Melbourne. In an illustrious career spanning more than 35 years, he has held a number of charges, including Member Tax Policy and Chief Commissioner Customs at Nhava Sheva, the largest seaport in India. Earlier, during his tenure as Member Customs at the Permanent Mission of India, Geneva, he made important contributions to the discussions in the WTO on a variety of issues, including the Trade Facilitation Agreement. His tenure as member GST saw many important changes carried out in GST law and procedure, both for easing the compliance of tax burden on the taxpayers and higher enforcement for tackling tax evasion. He also played an active role in laying the policy foundation for the rollout of GST and was instrumental in drafting the Constitution 115th Amendment Bill 2010, which laid the foundation of GST in India. His interests include music, reading, and painting. With this background, I would like to invite Vivek Johri sir to address us. Johri sir, please.
Thank you very much, Rajesh, for that
detailed introduction, and good afternoon, ladies and gentlemen. Thank you very much also DGTS for having me over for this seminar. I happen to wear the hat of member tax policy. I continue to do that at the moment and during the making of the budget this year. And so I'm here before you to give you a very broad picture of what we've tried to achieve on indirect taxes through the budget this year. Let me just first introduce the broad themes that we've tried to address through the budget. And one of the biggest, which you would have realized if you've gone through the fine print of the budget already, is that there's a major simplification of the customs tariff structure. I'll talk in a little more detail about that, but this is a very big change. And it's not just a change in the tariff structure or exemptions, it's also a change in the way we present tariff rates to the users and how we've attempted to make it more user-friendly. The second big area, of course, is that we've rationalized the rates of customs duties to support Atmanirbhar Bharat or Make in India, to support the MSME sector, which contributes so heavily to employment generation and exports, and finally also to the export sector directly. So there are some direct specific interventions which are meant to aid and assist these three sectors through tariff changes. Then we've made some changes in the legal framework of the Customs Act, and you're aware that the Supreme Court had made certain observations in the Canon India judgment and pointed out some gaps in the way we were applying the law in authorizing investigation agencies to do their work and to come in to deal with cases where assessments had already been done. The large import of these amendments is to align our law to the observations made by the Supreme Court very broadly. And, of course, you would have read the fine print. And I think during his presentation, Mr. Lohani would also explain to you, the details of these amendments. But they're very significant because they not only align our law with the Supreme Court observations, but they also clarify a lot of things about the working of investigation agencies, audit, etc. You're aware that the advanced ruling architecture for the customs, under the customs law, had undergone a change 3-4 years ago. We've made it a more decentralized architecture instead of having one single authority for advanced ruling in Delhi, which was very, very high level at that point in time. We've made it more decentralized. And you currently have two commissioners, one in Delhi and one in Mumbai, who look after advanced ruling. Our legal provisions in the Customs Act were not in sync with the new architecture. And so some changes have been made in the law to synchronize them. Another important thing about in the Customs Act, another important change is that the publication of any data or information which is disclosed to us in a customs declaration, whether it's a bill of entry or a shipping bill, has been recognized as an offense if it is unauthorized. This is obviously meant to protect data privacy and to maintain the integrity of data that is submitted to us by importers and exporters. On the customs tariff side, one more change that happens, with regular periodicity, is to incorporate changes that are made in the HS by the WCO every 5 years, depending on changes in the pattern of international trade and the significance of items that get traded internationally. That the HS undergoes a change. It has done. It has happened another time now in 2022. and it's only proper that our tariff schedule reflects those changes. So that's another set of changes that you would see in the tariff schedule. We've also tried to delineate better some of the tariff lines where there were concerns about, misclassification of goods and, the use of the others category in some cases, so that it helps in better monitoring of imports. On the GST side, I just have two broad comments to make. One is that you're aware that the system of returns in GST has undergone a change from the way it was envisaged when GST was introduced in 2017. At that time, there were three returns, GST R1, 2, and 3, that were envisaged. But over a period of time, the GST Council recognized that there was merit in continuing with what was initially a stopgap arrangement of GST R1, 2A, and 3B, and providing it an institutional and legal backing. And but the legal provisions of the GST law were still not completely aligned to the new return architecture, and so the major thrust of the changes in GST law are once again to align, the law with the return architecture of GST. These were amendments that were already approved by the GST Council in the year that has just gone by, and we've now carried out requisite changes through the. I mean, we are proposing requisite changes through the finance bill. There are some provisions in the GST law that have been introduced, and they've caused some concern, and we'll talk about that in my other interactions on the budget. These have been flagged to me, but these are changes that speak to fake billing, fake invoicing, and how to counter that. The concern that has been raised is that this is going to be this is going to result in unbridled discretion at the hands of field officers who may, in certain cases, misuse it and harass taxpayers. I want to use this forum to assure the House that that is not so. The architecture we have in mind is a centralized architecture for identification of cases where these kind of interventions are made, so that there's no subjectivity, at the field level most of the time. And the data then gets panned out to the field formations, who then take action and provide feedback. So we are very conscious of the fact that we do not want, a mechanism to be abused or misused in any way, and that it is used in a proportionate manner to deal with the problem at hand. But the good news on GST is also that there are some trade liberalization measures, once again approved by the Council in the course of the year, which we've now incorporated in the law. For instance, an entity, you're aware that businesses have to register across states under the GST law, even though the business entity may be the same. A problem that was flagged to us some time ago was that there is a difficulty in transferring credit from one establishment of that entity in one state to another establishment in another state, and this leads to surpluses in certain cases and payment of tax in cash in other cases, even though as a business entity, adequate credit is available for utilization. We've tried to ease that credit flow, and we've brought suitable amendments in GST law to enable that to happen from one state to another with regard to CGST and IGST credit. Similarly, there was a concern raised about the misutilization of credit, and what is the actionable sort of circumstance in which action could be taken for recovery of credit or for imposition of penalties. The point at issue was whether taking credit wrongly is adequate for treating it as an offense, or is it taking off credit and its utilization, wrongly, that should tantamount to an offense? The law is now clarifying that it has to be both for it to become actionable and for it to be recognized as an offense under the GST law. So those are 2 or 3 very broad sort of changes that I thought it was important to mention with regard to changes in the GST law. Now let me talk a little bit more about the cleaning up of the customs tariff, because I think one big abiding theme in this budget is, what we've done with regard to the cleaning up of the customs tariff. And this is an extremely trade-friendly measure, and it's also extremely useful for officers who have to implement the customs law and who have to read, decipher, interpret, understand the customs tariff. You would recall that in the last budget, the finance minister had announced that she would comprehensively review customs exemptions and improve the customs tariff structure. The undertaking at that time was that it would be completed by October of 2021. But owing to Corona, we could not sort of complete that exercise, as promised in last year's budget. We've taken it forward now, and what you see in this year's budget is actually a culmination of the exercise that began last year. The other thing which happened in the Finance Bill 2021 with regard to exemptions is that it was, the legal provisions were amended to reflect that all conditional exemptions would have a validity of 2 years. The purpose of doing that was to make sure that exemptions do not continue to sit on our statute books, even though they've become OTOs, they're not in use, they're redundant. And so, it was decided that there'd be a fixed time frame for which conditional exemptions would be valid when they're issued. What this would do is that this would impel the system to regularly review exemptions that are there in the statute book. So the cleaning up, in a sense, has become an ongoing, sustainable exercise because of these legal provisions. Now, what is the simplification we've attempted in the customs tariff? Let me talk a little more about that. So we had put out roughly about 350 to 400 entries, exemption entries, out in the public domain last year, after thorough scrutiny and examination of all exemptions in the tariff. And we had sought inputs from all stakeholders. We had done crowdsourcing of ideas. We've consulted the concerned line ministries, that are involved. It could be Department of Commerce, it could be Heavy Industry, Department of Industrial Promotion, MeitY, Petroleum and Natural Gas, Health, Pharmaceutical, you name it. So we've consulted them all. And in addition to that, there are 2 things that we've looked at in reviewing the exemption. So one, we've looked at what is the percentage, or what is the extent to which, not percentage, but the extent to which an exemption is actually being used or utilized. Is it significant? That's the first question. The second question, which we've tried to address through elaborate examination of data, is whether the exemption is actually being utilized by importers who it was intended for, or is it that some other beneficiaries, unintended beneficiaries, are availing of the exemption? What the ICAS system and automation of customs and the work that DG systems have done has enabled is that now you have very sort of granular data about exemptions and who are the users, who are the importers of these exemptions, etc. So that has helped us do a very thorough analysis of these exemptions. And so we've been able to remove as many as 350 to 400 exemption entries from the tariff based on this assessment that we've done. What we've also done side by side is that there were many unconditional exemptions that were sitting in, what we colloquially call the jumbo notification. So, the officers who are here with me, I think fully well recognize what I mean by the jumbo. So that is 50 of 2017 or whatever the number is, which sets out most of the customs duty exemptions. So what we've done is there were many entries in the jumbo and in other exemption notifications that were actually unconditional exemptions. And many a times they covered all goods, all goods of a tariff line. So it didn't make sense actually to continue them in an exemption notification. Therefore, what we've done is we've incorporated these effective rates, which were being operated through notifications, into the tariff schedule itself. And we've been able to achieve that for a very large number of tariff lines. Obviously, what it does is it improves the, the user friendliness of the tariff schedule, and it makes it so much easier for importers to ascertain what is the rate of duty applicable to any item or goods. So as far as possible, we've tried to build these rates into the tariff schedule itself. Many a times we found that there were minor gaps between what was exempted and what the tariff line covered, but we've tried to broad base it even in those situations, and we've built these exemptions into the tariff. Now, you're aware that there were some disputes with regard to, the classification and the applicable rate with regard to some textile items, mainly ready-made garments on the import side, because, there was a distinction made between men's and women's. And, in this age of unisex garments, it's very often very difficult to figure out whether a particular item is meant for use by men or women. So we've addressed that problem by equalizing the rates on many of these items. And likewise, there was a detailed exemption for many tariff lines of textile fabric, where a distinction was made between upholstery and non-upholstery fabric. We've again tried to equalize the rates for these exemptions as well. So these are two big areas, which generated disputes and made assessment clumsy and delayed. And we've tried to address them in this simplification exercise. There are many exemption entries in the jumbo that have a long list of items attached to them. You're aware that at the end of the jumbo, there's an annex which contains a number of lists, and they have to be read together with the exemption entry. These could be lists of items of machinery. These could be lists of items of drugs, pharmaceuticals, chemicals, laboratory reagents, what have you. And over a period of time, these lists had grown enormously. Many of them had become unwieldy. Many entries in those lists were no longer sort of relevant because technology has moved on. And some new items needed to be incorporated, to reflect technological changes. So in consultation with the line ministries, we've also rationalized, a large number of listed exemptions. The net effect is that the lists have been pruned most of the time and made less made easier to handle. In some cases of import of consumables and capital goods, which are used for certain operations, for example, petroleum operations. Again, there was a very long list which had developed all the way from 1982. And we made several attempts in the past to revisit the list and to prune it or to rationalize it, but we couldn't. But this year, we've been successful in doing that. We've pruned the list majorly to confine it to items that are easily sort of identifiable as for use in petroleum exploration and petroleum operations. So because the list has been pruned, the spin-off is that we've been able to do away with certification from the line ministry. That was one of the conditions prescribed in the notification. And we cannot depend on, a self-declaration made by the importer himself, because he's a recognized bona fide user of those goods by virtue of the fact that he's either a contractor, a subcontractor, a nominee who's permitted to carry out petroleum exploration operations in the country. There was a problem also with regard to disposal of goods which are brought in under this exemption. You're aware that in these situations, the problem that typically arises is what is the value of the goods to be used after taken for the purpose of assessing the duty after the goods have been used for a considerable period of time from the import. So what we've done is we've said that these goods can be disposed of as scrap or unusable material through MSTC, and whatever transaction value that scrap fetches, we've prescribed the uniform rate of duty to be applied as and when these goods are disposed of. So this is another leg of simplification that we've done in our exemption structure. We've also announced a phase-out period. There was some lack of clarity about what needs to be treated as a conditional exemption. I told you earlier that a decision was taken last year and a suitable legal provision incorporated to prescribe that all conditional exemptions will have a validity of 2 years. The question that arose is, what do you define as a conditional exemption? For example, are exemptions that operationalize a free trade agreement, are exemptions that pertain to export promotion schemes, conditional exemptions. So what we've done is we've defined this now, and these kind of exemptions, which are meant to endure for a longer period, have been kept out of the purview of the 2-year validity clause. And in all the other conditional exemptions, we've expressly provided a validity clause so that it's clear that the exemption is valid only for such and such time. The last most important thing, all the same, with regard to exemptions is the import of goods at concessional duty rules and the procedure that informs it. Now, for all end-use based exemptions, you're aware that under the customs law, in many of those entries, there is a requirement that the importer must, observe the import of goods at concessional duty rules. My congratulations to the systems team in CBIC. In a record time, they've been able to automate the IGCR procedure completely end-to-end. And that is a very big facilitation measure, which I do want to highlight, at this juncture. What it will do is, it will enable the user of an end-use exemption to file an intimation electronically. That intimation will travel automatically to the customs ports. And every time a bill of entry is filed, an import is made and a bill of entry is filed, making use of the end-use exemption, the data will be correlated with the intimation. There'll be no need for physical debits of these intimations or to keep an account on a case-by-case basis in the custom house. The return that the user is required to file every month, there'll be an ability to auto-populate that also, partly on the basis of the imports that take place and the information that is filed. So what will happen is that part of the return will get auto-populated, and it's only the balance that the user or the importer would have to fill in and again submit electronically. I think this is a very big change, and it's going to very fundamentally alter both our ability to monitor end-use based exemptions and the visibility to the taxpayer, to be able to see how much of material he's actually imported, utilized, disposed of, etc. One last thing I do want to mention again on the customs side, and bear with me because you know that the budget doesn't directly speak to GST. So the GST changes come through a different process, although the finance bill is used to implement many of the decisions taken on GST. So most of what I'm saying is related to customs, and you'll have to bear with me on that. The last thing I do want to say about customs is the change we brought about in duty structure for project imports. There were some, the standard rate for capital goods and projects for many long years has been 7.5%. But there were certain specified projects for which a concessional rate of either 0, 2.5%, 5% was prescribed over a period of time. Now, these were, to give you some examples, these were projects like coal mining, power generation, transmission, and so on and so forth. Now, what we've done in this budget is to rationalize the rate on all project imports at 7.5%. Some people have raised a concern, and I want to clarify that through this house, about the abolition of project imports itself. That's not true. So the project import scheme continues, and the project import scheme itself is a very big facility to the importer, because as you're aware, a large number of items that are required for a project, they get the benefit of being classified under one single heading at a uniform rate. If the project import benefit were not there, each one of these items would have to be assessed separately under the tariff, at different rates, and that would be quite cumbersome and difficult, both for the trade and for the administration. So the project import scheme continues as it is. It's just that the rates have been rationalized on project imports. And part of the rate rationalization exercise for project imports is also, dealing with capital goods. Now, capital goods has been a thrust sector for the government. It's recognized that this is a sector which has a huge potential for, generating value addition, employment in the economy. It can play a very major role in taking the share of manufacturing from 17% to 25%. And in support of that, what we've done also is that many exemptions on capital goods have been rationalized, and some pruned, like I told you earlier, and many others rationalized. And I think Mr. Lohani will deal in greater detail with those. So I think that's all I have to say at this stage. As I said, my remarks will be very, very broad in content. I'm so thankful to DGTS for, organizing this webinar. I can see there's a very large number of participants, not just from the department, but also from the trade. The whole purpose of doing this is to explain to you very clearly, the scope and intent of legal changes and other changes that have been made in, the budget through the finance bill or through notifications. So all the authors of the budget are here before you. Please ask a very large number of questions, and difficult questions if you can. We'll answer them. I'm not guaranteeing that we'll be able to answer all your questions immediately. On some, we may have to sort of examine in greater depth and get back to you. My apologies for not being able to stay for the entire duration of this program, but I would be watching all the same. Thank you very much.
Thank you, sir. Thank you for a very comprehensive coverage. As we say, the soul of the budget you have presented to all of us. And people always mention whether Mr. Vivek Johri, well, he can start from any section or any clause, any article, anywhere in the budget, and he can take you through the journey and mesmerize you. Thank you, sir, for talking us about the tariff lines, the GST law, the measures being taken about misutilization, the conditional exemptions, the capital goods, and all the same. And we can see, sir, that we have got more than 1,000 participants. And of course, we were anticipating this, and since our capacity was limited to 1,000, we started even a YouTube live telecast of the proceedings which are taking place. I hope those who are not able to log in could be able to utilize that. And it's good to see that out of 1,000, maybe 999 people are following the protocol and keeping their mic mute. Rest for 2 or 3%, 2 or 3 persons, I would again request to kindly mute themselves. And with this, after thanking, I'd like to introduce Mr. Ganesh Dutt Lohani. Is the Joint Secretary, TRU, a 1993 batch Indian Revenue Service officer. He has a degree in engineering and also in law. He has been deeply involved in policy making at the highest level in the ministry and the board. During over 28 years of service, he has contributed to all aspects of customs and central excise law and procedure, including formulation of tariff structure, classification of commodities, trade facilitation, valuation, rules of origin, bilateral trade agreements, etc. He has been associated with the design, formulation, and implementation of GST since its beginning. We are proud to have him amidst us and would like to invite him to address us. Mr. G.D. Lohani, sir, please.
Thank you very much, Rajesh, for this introduction. And good afternoon, all. In the beginning, this would not have a better beginning than Chairman outlining the features of the budgets and what we have done, along with the detailed objective. So, having heard from him in detail, what I will present before you is, in brief as to what we have tried to do in so far as custom rate structure and law is concerned. These are few slides here. Before I make presentation, I just would mention that these slides would, in brief, give as to how you look for what we have done. These are not exhaustive slides, but I will try to explain in the time allotted, say about 10 to 15 minutes at the most. And then we can have later on, we anticipate that a lot of questions will come, and there we will try to answer. And as I understand and appreciate from what is the kind of questions which are there in the chat box, people have read it. So I would not try to duplicate the effort of what has already been said. So I'll just share the presentation and I'll just take you through broadly as to what we have done. I hope this presentation is visible now to the people.
Yes, sir.
Right. So wait a minute. So this is where we are. Now, the outline of the budget is like this. There are a lot of changes this time, as you may have clearly understood from the details which were given by Chairman. Actually, this budget, while trying to do the simplification, tarifization, and also being progressive in so far as customs tariff structure is concerned, and so also certain nuance change in the law, a lot of work has gone into this. So in a very small time, if we have to explain, then broadly certain areas can be covered, but from there, the further detail can be seen. This is the first point. Like a lot of changes has happened in the capital goods and project import sector. The idea behind all these changes is that the capital goods exemptions have been continuing for many years now, and there were a large number of exemptions which were given in capital goods from time to time. So as a result, what happened is that, if you look at back, say 30 years from here, The custom duty rate structure used to be say kind of 250%, or later on it was gradually reduced. But while the tariff rate remained high, there were number of exemptions which were given over a period of time. What they were doing was that they were discouraging the domestic manufacturing of capital goods, and so also we were losing the multiplier effect of capital goods sector, which it has huge multiplier in that sense that capital goods backward chain is quite long, and actually there is a lot of value addition which happens. So the idea behind these changes is that a moderate tariff, not very excessive, but a moderate tariff on these kind of items which have a very high value addition, and also the potential of being manufactured in India, is significantly important. And this was highlighted in our national capital goods policy also. So we have taken from there. More importantly, this time we did a lot of consultation. As you may all be aware that we came to you through crowdsourcing. We interacted with the associations. So this time the exercise was not of 4 months, but this exercise of budget making was for the entire year. First time we came to tell us what we were going to do in this budget was last budget, when finance minister announced that a lot of changes and will happen over a period over this year in the custom tariff structure, and it will be comprehensively overhauled. So coming to capital goods, briefly they can be distributed in 3 groups. One, immediate withdrawal of concessional rates. These are few of the items which are mentioned here, but there are a large number of items where we have done that. These are such items which we feel that are can easily be procured domestically. They are available here, and we have domestic capacities. Then the other set number 2 is of that where sunset clause has been prescribed. As you may see that there are items, textile machinery, leather machinery, and power machinery in the group 2. So also the kind of machinery which are required for wooden fiber boards and packing and labeling machinery, and there are few other machinery of that kind, which we felt that sunset clause has to be given, so that the imports in pipeline or the planning or the manufacturing gestation period is taken care of. While doing so, while abolishing these exemptions, it was also felt that there are certain technologically advanced machineries which are right now not made. For example, certain items for textile and certain items for newsprint machinery, and so also of electronic industry. These exemptions would continue. So, so the detail has to be seen in this perspective, that these are broadly 3 categories which we have done in capital goods. Similarly, in project imports, if you see, these are broader list of project import. General project, all kind of projects, and then the iron ore, power project, coal mining, nat trip, water supply, and there are railway projects, and there are a number of projects like this. So what is the present rate of 0, 2.5 or 5 gradually moves to 7.5. How we are going to implement is that from next year September, all rate of project import would move to 7.5. But from this year September to next year September, the concession rate of 5 or 2.5 or 0 would be available only to those importers who registered for project imports before 30th September 2022. So this is how this project import is being phased out. Then about this, Chairman has already mentioned in detail, so I'm not taking up this slide, but we have done a lot of work for identifying those exemptions which were to be removed, which were redundant, or which had lost their utility over a period of time. So while doing that, large number of exemptions have been omitted. These are 350, so we are not, I would not dwell upon each of these entries, but these are there across chapters, across tariff items, and then certain items which are presently also being imported in significant quantity and which have significant requirements also. There in anticipation that these exemption withdrawal would lead to some kind of domestic capacity building, and also that we are only imposing some kind of moderate rate. So these end date has been prescribed on in a number of notifications. They are more than 60, which would be next year March or March thereafter. Then third change which has been done in customs duty review is that the rate which are right now prescribed in various notifications, they would move to the tariff, and so tariff simplification happens. Right now, what happens is that a trade or any person who has to read custom tariff, he has to navigate through a tariff first and then go to notification and read notification. And if an item is there in number of notification, then problem starts beginning that the number of rates coming from here, there, and and then interpretation issue come. So if these rates could be moved to customs tariff and they are in the schedule, then the only thing which is to be seen is to the rates prescribed in the tariff schedule, and that is how we see a significant simplification happens.
Lohani, sorry to interrupt you. We can't see your presentation.
You can't see presentation. Okay. I thought that this is there. I'll try again. Okay. I think got now can you see it? Is it visible now?
Yes, audible now. Yes, visible now.
Yes, now it is visible.
Right. So I was here, and anyway, I can reproduce this. This is the exemption which I was talking about. Then these are the changes which we have made about the customs duty review. This has been already spoken by chairman in detail. But three categories of changes: omission of exemption, full or partial immediately, large number of them. Then prescribing end date to the exemptions, which is happening in 2 phases, next year or year thereafter. Then most important change which has happened this year in the direction of simplification is that moving of all notification rates to tariff in almost all the cases. Few would remain this year, and gradually next year, hopefully they move to the tariff. So what does this do? The point number 3 is that those who are in trade and those who are in offices, those who are dealing with the customs tariff, they only have to see the customs tariff schedule for the rate. So this is a simplification. I was seeing the chat box. There were issues, there were questions whether we could give these updated tariff schedules and updated notification to the trade and display them on our website. We'll definitely try to do that. With these changes which we have done this year, it would be an easier task for us to give you an updated rate list of all items and the notification as they exist perhaps on the 1st of May. I'm seeing some problem is happening in this. Now, okay. Now, with that, you have to see the sectoral changes which are also very significant, which have been done this year. Electronic sector comes first. A lot of changes in this because we feel that there is a huge potential in the electronic sector to grow. This sector has done really well in recent years. As you see, phase manufacturing programs are there, which we have been implementing since 2016. Started with mobile, and over a period of time, we did for batteries, electric vehicle, X-rays, TVs, and such kind of items. So now there are phase manufacturing program. Notifications are clearly laid out for next 5-year roadmap for these items: wearable devices, hearable devices, smart meter, X-ray machines. And as you are aware, in PMP, we do it in glide path. The rate structure is defined in such a way that value addition happens. Similarly, there are a few other items which are there where we have rationalized duty rates so that electronic sector gets a boost. Item number 5 is very important. You have to carefully have a look at this. There is a significant raise in the customs duty of solar cell and solar modules and panel. This was announced last year, has been implemented this year from 1st April. The idea is that solar cell and solar modules, which will be consumed in the domestic market in a big way because of our aspiration in renewable, would be manufactured. We have significant capacity here, but capacity was not growing. With this tariff structure, it is felt that capacity is going to increase here. Similarly, there are certain changes in chemicals. Certain duties are rationalized, certain duties have been high. Then there are changes in petroleum sectors. Heavy feedstock gets a lower rate of duty. Rationalization of exemption for petroleum operation. This is a very significant notification where a lot of import happens, and major changes have been done here, including the simplification part of the procedure. Similarly, gems and jewelry. Diamonds and gemstone come down to 5%. Their demand was that even this 2.5% makes a significant difference to the gems and jewelry sector. Imitation jewelry gets a higher rate in that sense that specific rate is also being prescribed above the ad valorem rate, so as to ensure that undervalued imitation jewelry at least get rupees 400 per kg of tax. Swan diamonds, obviously, this is more of a kind of rate where only few may have been attracting rate other than nil. So it is being said that every swan diamond which is Kimberley certified would be nil rated. Of course, Kimberley certified means essentially rough and unworked diamonds. Worked diamonds, they continue to get 5% after getting down from 7.5% to 5% this year. Then steel scrap, important change in that sense that last year nil rate was given till this year only, this March. This rate continues for 1 more year. Then there are some small changes here and there, which are not sectoral, but they are significant in terms of value addition or our international relations, or our effort to make such changes that they gives impetus to certain domestic economic activities. Then there are certain changes which are like these item at serial number 5. The objective is that these inputs for manufacturing or aquatic feed get concessional rate, so that the exports of fisheries get a boost. Then, of course, there are other items where these are, again, you will see that in most of the cases, the rates have been rationalized for in the interest of domestic value addition. 6, 7, and 8 are again in the direction of that, incentivizing capital goods, eventually manufacturing in India. 9, and there are certain items like 9 and 10 where duty rates have been increased, but this is again, to encourage MSME segment. So there are certain other items of this kind which is to be seen in the budget document detail. Then the leather gets a reduced rate of export duty. This is relating to exports, not relating to imports. Presently, hide, skin, and leather they attract 40% in each. Last 2 years back, it used to be 60. So on graded path and gradual reduction, it now comes to 30. Then this is another change which has, it's kind of a scheme which has come in this budget, that duty-free import for the purpose of export by bona fide exporters is being allowed in certain sectors. As you may recollect that certain of this kind of exemption used to be there before last year, but that used to be open-ended. Now there is this is being linked with the IGCR and exporters obligation. So in a way, it's a kind of a proper export promotion scheme kind of thing is being built in the customs rate structure itself. Then certain CVDs and ADDs have been revoked. These were last year suspended, temporarily revoked. However, in this budget, they have been permanently revoked. So these mainly relate to steels, stainless steels and alloy steel and their products. Then there are certain miscellaneous changes. Please have a look at these changes. These changes may not have significant implication in terms of revenue, but in terms of litigations and in terms of disputes which were arising and on kind of interpretation issues. Other than that, also we have clarified certain issues like cesses, SWS imposition where customs duties are nil, or certain kind of clarification which was needed regarding the valuation in the tobacco products. So those are also to be looked at, carefully gone through. Then there are certain exemptions, miscellaneous kind of exemption which have been done in AIDC and health cess for donation. Actually, AIDC came last year and health cess also when it was brought. There was certain exemption where these were not built in. Now AIDC and health cess have been built in those exemption like Red Cross exemption, UNO, and then imports from Nepal and Bhutan. So these issues were being raised by the field formation. So please go through these changes and they address the concerns there. Similarly, there is a small change in the surgical needle norm. This is minor change as regard the imposition of health cess. Health cess has been exempted on this item. Now, on unblended petrol and diesel, there has been change in excise duty. ₹2 differential excise duty would be imposed, in fact, from 1st of October on unblended petrol and diesel. That is to say that this is not a revenue garnering measure. As you may see and as you may have heard in the budget speech, this is actually the objective is that blending of petrol and diesel is encouraged. And therefore, if unblended fuel is sold, then it attracts a differential duty. Now, customs duty, if you see the first one, a number of tariff lines have been created because of various factors, including those relating to PLI, those relating to textile. About textile, it was mentioned by chairman also, and textile has seen a lot of simplification in terms of rates also. So, and it's a major change which has happened in textile. So please go through those tariff changes, those notification changes, those rate changes, specific and ad valorem combination change to ad valorem only in the textile. Insofar as Custom Act is concerned, one important change is that we have made the schema as providing explicit provision for assignment of roles and function to the custom officer, and also prescribing jurisdiction, how jurisdiction would be identified, how action done are to be done within the framework of that. You provide modalities, and where board also would be assigning these jurisdiction clearly, where more than one jurisdiction has to be assigned some job. So there are 4 sections. Section 234 is a definition. Section 3, which defines the proper officer, the officer of custom, class of officer of customs. So section 3 has been comprehensively enlarged to include, say, officers of DRI, customs preventive, audit, etc., clearly in the law itself instead of prescribing them through notification. Section 5 has been amended and provisions have been incorporated here, whereby there are clear provision of assigning the role and function by the board, or as the case may be by the Commissioner of Customs or Principal Commissioner of Customs to the officers in the customs formation. Then comes section 110A. 110A is a new insertion. This is actually the objective of 110AA is to prescribe clearly the jurisdiction. For example, the cases where assessment has been done, duty has been assessed by one's formation, and then later on in audit or investigation, it is found that duty was short paid, not paid. How those cases are to be dealt. Similarly for refund and drawback. And if multiple jurisdictions are involved, how the jurisdiction would be assigned. So this is a comprehensive package insofar as assignment of role and function is concerned. This takes care of the infirmities which have been observed by the courts in few of the recent judgment, including one that was of canon. Then there is a validation also clause which is there in the Finance Act, which is to be which may be seen carefully, validating certain action in the past by the customs officer under the erstwhile provision. And the custom officer, the action which are validated are as per the amended list under section 3. Those are the custom officers which have taken action. They have been validated for the past. Then an important change, we feel that there is undervaluation in a systematic way in certain kind of commodities, and there in these items where we feel, as one example which you saw in the presentation itself, of kind of imitation jewelry. So we realized that if imitation jewelry is made of brass, and brass is, say, for example, 500 rupees per kg, then if imitation jewelry made of brass is of 100 rupees per kg, then obviously there is something amiss here, and that undervaluation is clearly visible. So new formulation in section 14 is there that additional obligation can be cast on those items which are identified by the board as having undervaluation based on certain analysis to be done, and provision will come the detailed provision prescribing as to how we will identify those items and how and what procedure would we prescribe and what obligation would be cast on the importers. Those would subsequently be coming once this act come into force. Then there are certain miscellaneous and technical changes which are for resolving disputes. So you may have seen it. Otherwise, please go through these. There are a number of such kind of changes where we have made these. These are only to correct the anomalies. And then SEZ reform in the budget document, you would not see much of this, but this is in the speech, and this is a work is to be done in the coming year, in the coming financial year. What it is being said is that SEZ Act would be replaced with a new legislation, and this new legislation would cover number of enclaves, industrial enclaves other than the existing SEZ. And also at the same time, custom administration of SEZ would be comprehensively reformed. The idea is that now entire custom formation in the country, whether they are in SEZ or outside the SEZ, they should be working in the same common national customs portal, and it should be IT driven totally rather than the the kind of checks and the kind of system which is there in the SEZ presently. So essentially what it means is that the customs processing, custom filing and custom analysis and risk assessment and determination thereof would be done in the custom national portal even for the SEZ when this change is implemented. So this is from my side. I have tried to explain in brief, but we'll take it up in the question, whatever questions are raised there.
Thank you, sir.
Right.
Thank you for a very comprehensive presentation. Sir, with this, now I would like to invite Shri Sanjay Mangal. His brief introduction. He's an officer of 1992 batch of Indian Revenue Service. He is a graduate in Electronics and Communication Engineering from NIT Kurukshetra and an MBA from Faculty of Management Studies, University of Delhi. He has worked in different capacities in the Government of India for past 29 years in various wings of CBIC as well as other ministries. He has been associated with GST since its introduction, first as Commissioner of a CGST formation for 2 years, and then as Commissioner and Principal Commissioner of GST Policy Wing in CBIC for the last 2.5 years. As there are some misgivings in the industry about the GST provisions, it would be apt to invite Mr. Mangal to address us. Mangal, sir, please.
Thank you, Rajesh. Good afternoon, everybody. Good afternoon, my colleagues from department as well as colleagues from industry. And Chairman CBIC had given an overview of the changes which have been proposed in GST through Finance Bill. He has given a brief overview of that. I will go in just a little more detail than that in my presentation. It's a very brief presentation. And then we can take the questions which are being flagged by various people in the chat box as well as otherwise. So I will just make a very short presentation on the important changes which are there in the Finance Act pertaining to GST. So I will share my. Is my screen visible?
Yes, sir.
Okay, so I will the changes which have been proposed in Finance Bill 2002 pertaining to GST are all basically based on the recommendations of GST Council. So as Chairman has also told, they have been discussed in various GST councils. Mainly these provisions were approved and recommended by GST Council in its 43rd and 45th meeting in May 2021 and September 2021. And they have now been introduced to Finance Bill. The main emphasis of these provisions in amendments in GST Act is to align legal provision in Act with the present scheme of GSTR 1(3)B return filing. As Chairman had also told, the earlier scheme which was envisaged in GST Act was of GSTR 1(2)(3) system. But ultimately, Council had decided to implement GSTR 1 and 3B sort of system. Then in 42nd meeting, Council decided that initially it was decided that 1(2)(3) scheme will be implemented, but ultimately in 42nd meeting, Council had decided that 1(3)B scheme will continue. It will be the final return filing system in GST. As people have got accustomed to it, they are finding it quite comfortable with this system. So in 42nd meeting, it was decided to continue with it, and then the law amendment pertaining to that to align the act with the GSTR 1, 2B, 3B filing scheme is now being done through this Finance Act. So mainly the provisions are in clause 99 to 113 of the Finance Bill, and there are also some provisions there which are pertaining to trade facilitation, and some are compliant related. There are some retrospective amendment in notifications also, which are proposed to clause 114, 115, 118, and 121 of Finance Bill. They will come into effect on date of its enactment or enactment of the Finance Bill, and the other provisions 99 to 113, they will come into effect to be decided by Council, because they have to be it has to be coordinated with states and UTs after getting it passed through them. Their respective legislations. Yeah. So I will start with trade facilitation measures. First measure, which had also been talked about by Chairman, was amendment in Section 49. This was also announced earlier in Council meeting that because there was a demand from people that the taxpayers having a same PAN but having registration in different states, they have got their accumulated cash in their electronic cash ledger. And as per the existing provisions, they are required to take refund of that amount, and then they can deposit it in the cash ledger of the different distinct person. But it has now been proposed in Section 49 to introduce a provision by which the amount can be transferred in electronic cash ledger of one distinct person to another distinct person. So this will help in improving liquidity of taxpayers who have got multiple registrations in different states. Another major change which was approved by Council and which is now being proposed through the Finance Bill is a retrospective amendment of Section 53, subsection 3 of Section 50, providing that interest will be charged only on that portion of ineligible ITC which is availed as well as utilized. Because earlier there were interpretations that it will be availed, it can be on that amount also which is availed but not utilized. So to clarify the thing, to make it very clear, a retrospective amendment is being done now with effect from 1st July 2017 to make it absolutely clear that interest will be charged only on that portion of ineligible ITC which has been availed as well as utilized. Also, because rate of interest in Section 50, subsection 53, which has been notified, is 24% at present. And retrospective amendment in the notification is being done with effect from 1st July 2017 to prescribe rate of interest under Section 53 to 18%. So that the interest which will be leviable on refund, which is availed as well as utilized, will only be 18%. So this will help in removing all the disputes and legal ambiguities and will benefit taxpayers at large. A third measure relating to trade facilitation is amendments in provisions of Section 54, which is refund provisions. One first measure in refund provisions is that the time limit for claiming refund by an entity under Section 55, that is having a UIN number, which can be a UN entity, which can be diplomatic missions, embassies, or some other notified persons. This was notified as 6 months now from the last day of quarter in which supply was received. So this period has now been extended to 2 years on par with other refunds under Section 54. This will give more time for such entities to claim refund. Then a second amendment is being done through an explanation of Section 54 regarding relevant date for filing refund claim in respect of supplies made by DTA units to SCZ units. So there were some ambiguities regarding that, and there were some confusion regarding relevant date for filing of refund in case of entities for claim of accumulated ITC refund for such supplies to SCZ units. That has now been made clear through this explanation added in this clause added in explanation 2 to Section 54. Third, there was some doubts, although we have made it clear through our circular about the manner of claiming refund in balance in electronic cash ledger. The existing provision provides that it should be claimed through the return, although as per the existing scheme, it was being claimed through RFD 01 only. So as to provide it very clear, we have now amended this provision of claiming refund of balance in electronic cash ledger. So again, all these provisions will remove doubts and ambiguities and make the provision easy to implement. Third measure, which is the next measure, which I would like to highlight, was a demand from most of the quarters regarding amendments in various returns, as well as date of availment of credit and issuance of credit note, etc. As per the present provisions, the date is linked to filing of September return of the next financial year. So demand was there that this should be allowed up to annual return. So we examined, the council examined this demand, and then it was thought that if the date is extended to annual return, then it will again create a lot of problems, because then there will be demand that you have extended this date till, for example, 31st December, which is due date of filing annual return. So that will lead to demand of extension of date of annual returns. So it has been made very close to annual return now. And it is a uniform date now, 30th November, instead of date of filing return in some cases, due date of filing return in other cases. So now it is a uniform date of 30th November, which is 1 month before the last date of filing annual return, and it will help taxpayers quite immensely. Now I will touch upon the main provisions which are there for alignment of our return filing system with GSTR 1(3)B return filing system. Section 37 is amended, in which two-way communication process has been done away with. And again, one provision we are adding, because GSTR 3B return filing is already sequential, but GSTR 1 return filing was not sequential in the Act. So now, as GSTR 1(3)B is linked, and data of GSTR 1 is being auto-populated in GSTR 3B, it is essential that there should be a discipline in GSTR 1 filing also. So for that purpose, return filing of GSTR 1 is also now being made tax period wise sequential. Now Section 38 is being substituted, because earlier Section 38 provided for filing of a statement for inward supplies. So now details of inward supplies. So instead of that, now, because we are not going into that scheme of GSTR 2, and we are following the scheme of GSTR 2A, 2B. So Section 38 being amended for communication of details of inward supplies as well as input tax credit to the recipients by means of auto-generated statement, which will be GSTR 2B. Such auto-generated statement to contain details of inward supplies in respect of which input tax credit may be availed, and also supplies on which input tax credit may not be availed. So this provision is now made in Section 38, and simultaneously Section 16 also is being amended accordingly to make a provision that wherever any input tax credit has been made as non-available in section under communication under Section 38, then the credit will not be available in respect of that particular supply. Next, Amendments are being made in section 39. As I am mentioning that presently GSTR 1 3B are being linked, as data of GSTR 1 is flowing into 3B, like it is getting auto populated on basis of that. So there is a requirement that for this auto population, it is essential that GSTR 1 should be filed before filing of GSTR 3B. So now a mandatory provision is being made that GSTR 1 should be filed, only then GSTR 3B will be allowed to be filed. So this provision is being made in section 39. This is an addition. And the due date of filing of return by a non-resident taxpayer, which was earlier 20th, it is being preponed to 13th. So as to allow generation of GSTR 3B for these details also, because GSTR 3B 2B is now being generated on 13th night. So this will help in that. Section 41 is being substituted. Earlier it provided the claim of ITC on a provisional basis. So now that concept of claim on provisional basis is not there. Now it provides for availment of self-assessed input tax credit, so subject to such conditions and restrictions as may be prescribed. Besides, in 41 there was a demand earlier that section 16(2)(c) says that the credit should be availed only if tax is paid by the supplier. Now there was no mechanism how this will be reversed or how this will be done. So section 41 is providing an enabling mechanism, enabling clause that through which a mechanism can be provided now through rules for reversal of ITC if tax has not been paid by the supplier, and if subsequently tax has been paid by the supplier, then how to reclaim the credit. So the necessary rules will come based on that. That will provide the mechanism. Section 42, 43, 43A. Section 42, 43 were there for matching, reversal, reclaim, either of ITC and then of reduction in output tax liability. So these, because of change in structure now, this two-way communication is not there. And accordingly, 42, 43 have been done away with. 43A was introduced but never notified. And 43A provided a mechanism for new return system. And based on, and it also provided some spike rules based on which the credit flow could have been stopped. So this 43A was though not notified. Now 43A has been omitted altogether, and the provisions of the 43A spike rules have been tried to be introduced in section 38 itself. There are some miscellaneous provisions. Section 29, which is cancellation provisions. It was required to be amended because composition scheme, the section 29 subsection 2, clause B and C, they provided for cancellation in case some returns are not filed. In case of composition dealer, because earlier quarterly return filing was there, the provision was aligned by as per that. But now as the annual return filing system in composition scheme is there, so now the provision is amended accordingly. Similarly, for people other than who are not in composition scheme, the present clause provides return filing of 6 consecutive tax periods. Now, because of QRMP scheme and quarterly return filing scheme and not, we have made this flexible, and the time period after which the cancellation can be done can be prescribed through the rules. Section 47 again is being amended. There was a lacuna that there was no levy of late fee for delayed filing of GSTR 8 by persons who are deducting tax under section 52, who are deducting TCS under collecting TCS under section 52. So that has now been provided, a levy of late fee for such people, delayed filing of such returns. Section 49 is being amended to make a enabling provision for prescribing maximum proportion of output tax liability that may be discharged to electronic credit ledger. This is to make it amply clear, although the provisions existing, we thought that existing provisions of 49 also allowed that, and based on that, the rule 86B had been prescribed earlier, providing for 1% cash payment in certain cases. But now a specific clause has been, a specific subsection has been added in section 49 for that purpose. So there is nothing new in it. It is just for just regarding that. So these are the main proposals which are there in finance bill pertaining to GST. I am now like we will as there are a number of issues which I am seeing in chat box. Besides, there are a number of issues pertaining to customs also which are there. So I will leave it to the organizers how they want to go ahead regarding the queries and questions and answers. We are ready to take the questions.
Thank you, sir. Thank you for a very detailed presentation. And of course, we are going to take up the question. But just before that, we would first invite a panelist. I would like to introduce Mr. Pramod Kumar. He is a 1988 batch officer, a science graduate with a degree in law. He has vast experience of working in various wings of the department across the country. He is currently posted as a Director General of Performance Management with the additional charge of the taxpayer services. He has preferred that our time be utilized for the question answer session and his not coming up for a formal speech. So I would introduce our next panelist, Mr. Uday Pimprikar. He's partner, India Indirect Tax Leader in Ernst & Young. He has more than 24 years of experience in advising clients on various indirect tax legislations, including customs, foreign trade policy, excise, goods and service tax, and also value-added tax. He has handled advisory, compliant, audit, investigation, litigation structuring, and due diligence related assignments during his work. He is an active member on several trade associations and has also advised many trade associations and participated in deliberations with government. Today, he is representing the CII. I would invite Mr. Uday Pimprikar to kindly speak. In view of the shortage of the time, I'll request all panelists to be precise and so that we can have some time for the question and answer session. Mr. Uday Pimprikar, please.
Thank you, Doctor, and thank you, the entire institution of DGTS and for inviting me here. I was there for the entire presentation and a brilliant presentation by all the speakers before me. So I'm not going to spend too much time. I would just like to say 2-3 broad things. I laud the CBIC for going through this huge effort that they've gone through on what they're calling a tariffization and review of this entire exemption processes. I think it shows the humongous amount of effort that has been put in. There would be areas when these kind of amendments happen related to the tariff. I'm sure that there would be areas where there would be ambiguities that can come in. And I think maybe in a different forum, maybe under the auspices of DGTS itself, it might be useful for engaging with Mr. Lohani and the policymakers to kind of go through some of these. The second bit is that even on the GST front, sir, and I think I can see a huge amount of questions. On the GST front, I think there is a need for perhaps a slightly detailed interaction on the implications of some of the changes that have been proposed, especially related to the credit. These are going to create some bit of from a process perspective, areas of exposures for bona fide taxpayers. And to my mind, I think these would need to be addressed. And the third bit is that I would really like Mr. Mangal to kind of perhaps talk about later on what would be the agenda on the GST front. I would like, to be honest, some bit of discussion about decriminalization, simplification of the legislation. We are in this particular stage on the GST journey whereby I'm genuinely afraid that there would be a significant amount of uptake in litigation if some of the simplification measures and some rationalization of provisions are not made. And so some of this would need to be taken up as a separate work stream. CII will be extremely happy to kind of engage with the policymakers on that front going forward, but this needs a requirement. So thanks a lot and a brilliant budget, I can say. I'm sorry if I took too much time, Doctor. Thanks a lot.
Thank you for being very precise and to the point in your address, Mr. Uday Pempika. And I think this makes me go for the next speaker. I will invite Mr. Bimal Jain. He is the chair of Indirect Tax Committee of the PSD Chamber of Commerce and Industry. He has vast experience in indirect taxation, GST, service tax, central excise, customs, VAT, FTP, DGFT matters, etc. And is also the executive director of A to Z Tax Corp. I'd invite Mr. Bimal Jain to kindly address us. Mr. Bimal Jain, you may also raise questions if you so like.
At the outset, let me thank Chairman Sri Vivek Jodiji, CBIC. Excellent opening remarks by him, alongside excellent presentation by Lohani ji and Sanjay ji. Thanking DGTS team led by Mr. Pramod Kumar ji, Dr. Rajesh Kumar Burma, and all the DGTS members. From PSD CCI, we are representing MSME sector. Let me congratulate and really the laudable decision is being taken, rationalization of basic custom duty on raw material, component and parts used for local manufacturing. It is really boosting Make in India, Atmanirbhar Bharat, self-reliant, laudable, rationalization on basic custom duty for the raw material, inputs and component for domestic manufacturing. Going forward, SEZ Act now going to be repealed and more inclusion and more coverage for the new and existing unit, whereby contribution of both central and state would be allowed. But here one point I would like to draw, if we can allow export on INR as against convertible foreign exchange, that will help in protecting fluctuation in the convertible foreign exchange. Coming to the third, GST, the highest ever collection, first time in January, 1,40,000 crore rupees. A lot of trade facilitation measure is being taken up. Like time limit got extended for availing credit. Then they have allowed the time limit for the credit note also. Alongside, we can amend GSTR 1 and GSTR 3B 30th November. Allotment trade facilitation, transfer of e-cash ledger from one distinct person to another distinct person. But what is worrying in GST, 2-3 pointers, and here I would like to highlight for CBIC policy being to look into the matter. GST input tax credit was stated to be seamless flow of credit. That was the object clause when GST got introduced. But day by day, we are finding input tax credit is not coming as smooth as it was stated. Even this year budget, we have seen the provision, restriction is being announced, sixth condition is being introduced under subclause BA under section 16 subsection 2. That is not the end. At the same time, 6 more conditions are being inserted under section 38. Now, credit is dependent upon supplier. Supplier has to file correct return, timely return, and the recipient has to really, check it out. Not two-way communication is gone. It is fully dependent on the supplier. And even we have seen the supplier, sometimes small supplier, they are not having enough education or enough system to really implement GST the way we are looking for. So maybe for seamless flow of input tax credit, we have to look into the matter and we have to allow some space, handholding. We all are learning a process for the region. Initially, we thought of automated GST return system, but now we are withdrawing that system and we want to continue with GSTR 1, 2B and 3B. I'm giving two pointers to Sanjay ji because he's heading policy wing. If I'm availing credit in my 3B, which is exceeding with the 2B, there may be many regions that 2B credit is auto-populated and not auto-populated for either or region. And it is being stated under section 38 that the credit can't be available. So I'm not deliberating on those pointers which we can carry on, but at the same time, GST require little more hand-holding for all the sectors, small sector, medium-sized sector, and large sector. Being time is paused today, but thanking each one of you for giving me this opportunity and thanking DGTS team for organizing this webinar. Thank you very much.
Thank you, Mr. Vimal Jain, for your lucid address. And yes, hand-holding has been a major part of CBIC, and even the program we are having today is in fact one of the outreach we are holding for the trade, where the whole board, everyone related to the budget making exercise are here to address the trade and industry. With this, I would like to introduce now Mr. P. Rajendra Kumar. He's a chartered accountant with a practice of over 3 decades, and he currently leads the GST and Indirect Tax Committee of ICI. He's on board of reputed corporates and is internationally recognized expert on GST and VAT, and is the only Asian on technical advisory group of OECD. A widely traveled person, RK, as he is popularly known, has presented more than 1,000 papers in the areas of VAT and GST in India and abroad. He loves to guide and interact with students. And with this introduction, I would like to him to address us. Mr. P. Rajendra Kumar, please.
Thank you, Dr. Rajesh Kumar Verma ji, for the nice introduction, and thank you for this opportunity. On behalf of the Institute of Chartered Accountants of India, we would like to commend the proposals that have been introduced in this Union Budget 2022 with specific reference to GST and the customs tariff also. In fact, we recognize the fact that the World Customs Organization has introduced from January 1, 2022, the 7th edition of the HSN with numerous changes. In fact, from the Institute, we had the opportunity to attend the WCO's open public forum that they conducted in 2019 May at Belgium, wherein 2 days discussion took place on the classification structure and the new introduction of goods that are introduced in the market on a regular basis. And I'm happy to note that the customs tariff also is moving towards that particular region of adopting the amendment that have been made. Nevertheless, the amendments that have been proposed, especially with respect to the tariff in customs, will certainly help, and we are confident that it will go far-reaching changes will be coming very soon. The second point, from 2017 till now, numerous amendments have been made in the CGST Act. And if I open the CGST Act of 2017 and if I open it today, I mean, it looks so different. So our suggestion here is, let us go in one single stroke. Let us go overall and look at the entire CGST Act can be changed, can be brought to its current usefulness, and the manner in which the changes have been made may be introduced in its entirety. So can we take a relook at the entire CGST Act, given the numerous changes, given the trade and industries requirements and so on? ITC, in fact, yesterday, Mr. Nagendra Kumarji was also here with us in the Institute's program, and we did make a mention that input tax rate is the fulcrum. It is a fulcrum of the entire GST structure. And yes, every country, every taxpayer would always want a seamless credit with lesser and less restrictions. We do recognize the fact that ITC cannot be something without restrictions, something without conditions. But then at the end of the day, the trust of the government matters the most with the taxpayers. So the government comes one step ahead, the taxpayer also comes one step ahead. Let us make ITC smooth. Let us make ITC I will not say that let it be totally seamless. It cannot happen. And especially in a country like India, I certainly go on record that it's near to next to impossible. Even smaller countries have tried that and failed. So let us look at ITC in its entirety. Yes, with respect to the amendment on the availment and utilization of the credit with the GST Council discussed, and then the amendment has come. It is welcome. I would only close my small talk here with a request that the CGST Act and the rules may be looked at in its entirety. It's time. It's 5 years now, and it's time that we took a general look at it and also adopt international best practices. Thank you very much for the opportunity, and we from the Institute, being a creation of the Parliament of India, are always available for any discussion and for any hand-holding. And whenever you want us, you will find us standing next to you. Thank you very much.
Thank you, Mr. P. Rajendra Kumar, and thanks for your word of support. And I remember when the GST came in, the ICI was standing shoulder to shoulder with CBIC in all the outreach activities which were taking place then. Thank you. And now, sir, with the approval of Lohani sir and Mangal sir, I think we can take up the questions which are there in the chat box.
Yeah, we can start. You can decide modalities. You will take up.
Sir.
You pick up the
Sir,
questions.
when I started looking at these questions in the chat box, I realized there are some which are suggestions, some which are merely welcome and words of appreciation. Since we are short of time, I don't see any point of repeating those words. We thank them, thank the trade and the members who have said that. And let's come straight to some specific questions. There is Mr. S. Kali from Sterlite Technologies who says, sir, we welcome the move of the CBIC and chairman towards a provision for transfer of cash ITC in the electronic cash ledger, which can help industry. We as industry also request the government accedes to our request by providing a similar relief to the industry by utilizing the ITC of CGST, SGST and IGST lining in electronic credit ledger of other states for the tax payment of other states its distinct entity with the same PAN but registered in different states. Says that this will ease the working capital blockage as they are executing multiple projects on pan-India basis. Mechanism procedure may be prescribed, sir.
Thank you, Mr. Kali, for your question. This issue was deliberated in Law Committee and Council. Like while the issue was taken up, the issue of allowing transfer of unutilized cash in electronic cash ledger as well as unutilized credit in electronic credit ledger from one distinct person to another distinct person was discussed. It was found that in case of cash, unutilized cash, presently there is a provision in the Act to allow refund of such unutilized cash in electronic cash ledger by any person, and then he can take refund and he can utilize in any manner. So the provision, the facility which has been allowed by council was that instead of taking refund in one distinct number, one GST and then again putting that amount in cash ledger of another GST, there can be a seamless process on the system itself where taxpayer himself can do this transfer without intervention of tax officer. So this has been allowed. As regards credit, presently also there is no provision in the Act that any person who has got unutilized credit in the credit ledger, he can take refund of that. The refund of unutilized credit is allowed only in two circumstances. One is case of zero rated supplies, and second in case of inverted duty structure. Other than that, refund of unutilized credit in credit ledger is not allowed in GST Act. So transfer of unutilized credit ledger from one GSTN to another GSTN would have tantamount to such refund of unutilized credit, and that's why GST Council has not agreed to that. Thank you.
Can I, sir, Doctor, can I just add this from the industry perspective? What the ask was that pre-GST, the quantum of credit was availed on a pan-India basis, especially for most of the sectors. And post GST now, given that there are individual pools that are happening, okay, that's significantly increasing the working capital. So the ask from the industry was to allow a transfer of the credit ledger so that for only CGST or IGST, which is central levies, and maybe not even the state levies, to reduce this. So it was actually the ask was to take it back and have a same kind of effect as it was pre-GST, because post-GST, actually the working capital requirements have gone up. So that was the perspective which the industry had come back, sir.
Udayji, this was discussed. We will again examine that from the perspective of only the CGST portion, because as you know, SGST and other portions, because states have got interest, so that will not be allowed. From CGST angle also, they have got there are implications on state revenue, even on part of CGST credit transfer. So there are the states did not agree to that, and we can have a relook at appropriate time. I can only say this.
No, thanks a lot, sir. Thanks.
Thank you.
There seems to be repetition of questions, like Mr. Milan Mehta has posted this question again and again. On similar lines like GSTR 2B to GSTR 1, when is table 12B expected, where we can get idea about our supplier?
I can explain the question. This question is being asked by a number of persons. The issue is because there is a condition in section 16(2)(c) that tax can be availed when the ITC can be availed when tax has been paid on the said supply. So the query appears that how do the recipient know about this whether the tax has been paid by the supplier, and how do he avail or reverse this credit? This provision I had explained. We have introduced this subsection 2 in section 41 in the proposed amendments, whereas we will prescribe through rules the manner for reversal of such credit if the supplier has not paid the paid the tax, and recredit of the same. Let us wait for some time. We will provide for some mechanism, and taxpayer will also get to know how to reverse credit in such cases.
There is another question. Can the department upload the updated customs tariff on their website ASAP, please? Definitely. Systems boys are working and it would come up shortly. It will be very quick. And Mr. Kaushik Ghosh, he asks, sir, in certain cases, input tax credit is greater than output tax and credit gets accumulated. It's a question of accumulated credit in certain industries. And perhaps they are asking whether in any kind of refund of the same or some cashback of the same can be availed. I think gems and jewelry sector was one, and there are some other industries in which where the final product gets taxed at a lower rate than the inputs, leading to accumulation of credit. That's a question Mr. Kaushik Ghosh is raising.
I don't understand the apprehension, because presently also refund is allowed in case of zero rated supplies as well as inverted duty supplies. So maybe the question the question is something else. I am not able to understand the question properly. What is the apprehension?
If Mr. Kaushik Ghosh is around, if he is there, he can unmute himself and raise the question. Mr. Kaushik Ghosh.
Yes, go on out.
He's not there. So how there's Master Manoj Tiwari to everyone. How payment of GST by suppliers will be communicated? Again, the same question in a different language. Congratulations, thank you for the congratulations. Removal of some vaccine items from list 3 and 4 of 50 by 2017 has financially impacted clearances by SEZ into DTA. Request for continuation of these exemptions. This is from Mr. PC Nambiar to everyone.
Mr. Nambiar, these list 3 and 4, they have been amended after due consultation with the trade and industry. Also, we discussed with the pharma, and after extensive consultation, in fact, these lists were placed in the public domain also for crowdsourcing. What we realize is that in the domestic area, there is sufficient capacity to manufacture these pharma products. So taking into account the details which were provided to us from the industry itself, these lists have been reviewed, and accordingly the intention is that the domestic industry which is capable of providing these items should do it. Of course, SEZ suppliers in that case have to suffer the customs duty, because the present rule provides for payment of customs duty by SEZ. So merely because SEZ has to pay the duty, you will appreciate that tweaking the exemptions may not be feasible.
Yeah, sir. We only say that whenever supply is made by an SEZ unit to an exemption can be given. We are not talking about the amending the custom. Till September, because September we expect that any sale from the SEZ to D, till such time at least these there could be a notification. The SEZ to the DTA unit within India.
I could not hear what you said, but I understand that what you are saying is that there is, a SEZ Act amendment would be there, and you are anticipating certain things there. In that would happen after September this year. But SEZ framework change actually would come in some time to maybe next 3-4 months, as Commerce has mentioned. It does not necessarily say that there would be any significant change about the duty framework. So you will have to wait for that. But as of now, the SEZ supply to DTA are treated on par with imports, and that is a reality in terms of SEZ Act. And it's not that we have been exempting specifically SEZ supply to DTA while not exempting imports. So that is the matter of fact on which we are working. And wherever customs duty exemptions have been omitted this year, the natural corollary is that SEZ to DTA would attract the customs duty, which normally applies to the imports.
Thank you, sir. Thank you for the reply. But we have reached 4:50, unlike originally planned time of 4:15. To the three panelists who are there, I would give an offer of raising one specific question each, and to our speakers, if they would like to pick up any one question which they think represents the requirements of the vast majority, they may pick up any question from the chat box and answer. In the meanwhile, the panelists, the representatives from the trade, because I take it as they know what the trade wants. So I would request them to raise one question each so that we can end it in another 5 to 10 minutes.
Sanjay, shall I ask Rajesh ji, Dr. Rajesh?
Please, Vimal Jain sir, one question.
Yeah,
please.
I'm thankful to Sri Sanjay ji for giving all the answers, whatever best possible. Just one specific question. Sanjay ji, under section 16, subsection 2, clause C, problem is that supplier has not paid the taxes even after collecting. Now you have brought the provision under section 41, subsection 2 for reversal of credit along with interest and re-avail the credit whenever paid by the supplier. Question is, this is going to be prospective clause. So period prior to this particular clause, if supplier defaulted and department knows that supplier defaulted, he has not paid, then can't we make some provision that this should be collected from the defaulting supplier rather than penalizing the buyer, bona fide buyer and recipient?
Vimalji, the provision is not collection of duty from the recipient. The provision is availment of ITC. So collection of duty, if any, will be done from supplier only. But if it is found that supplier has not paid the tax, but credit has been taken, then the provision was that the credit is not available. And as you know, the present provisions are like this: that GSTR 1 is filed on 11th, or IFF is filed on 13th, whereas GSTR 3B due date is 20th. So this one-to-one correlation cannot be within the same month, because the supplier can pay duty till 20th, and which is the same date on which recipient also has to file his return. So as per the present provisions, nobody is being stopped from taking credit during the same month, because there is no way the recipient can know whether supplier will pay tax on that or not. But it is duty of recipient, because now in GSTR 2A it is being mentioned whether for that particular supply GST for that month supplier had filed his return or not. Actually, till this much information is being given. Now somebody may say that we cannot know whether for my supply tax has been paid or not. But to the extent, at least supplier the recipient knows that the supplier has filed return or not, then on self-assessment basis he can reverse that amount. Now in future we are going to prescribe a specific rule for that, which will be more clear how to find out with respect to a particular supply whether tax has been paid or not. Presently it is for the return as a whole. Now we can prescribe rule to find out whether for a particular supply the tax has been paid or not, and then the reversal and all. So we let us wait for some time. We will come out with a recent rule after consulting trade, and which will ease out the process comparatively.
Sir, the question is there should be a role of the officers also of the department to catch hold of his registered dealer who has not paid the tax. And the
Definitely that is there. I agree perfectly. That is why first we have introduced this provision of section 7512 explanation, which was introduced with effect from 1st January. And that provides that once first GSTR1 has been filed, which is the self-declared by the taxpayer, and this will be considered as a self-assessed liability and will be collected from him, will be recovered from him, and it is the duty of tax officers to collect that amount from the taxpayers. Okay, but simultaneously till that time, if by chance the person is not existing, I don't know, person may not be existing. There are number of cases where frauds are there, that the supplier has just passed on credit through GSTR1 and the recipient has taken credit where a supplier is not found existing, then where will the go? Where will the officers find out such person? They will try definitely, but again, because the recipient is knowingly taking tax on that, it is required that such ITC should be reversed.
But in those cases where the registered,
I think, sir, please, agreeing and counter that may not be possible at this stage.
Only one point, Vermaji, only one point from the institute here.
Yeah, Mr. Rajendra Kumar, please.
Yeah, sir.
Question.
There is this provision where if the recipient does not make a payment to the supplier within 180 days, the ITC reversal needs to take place. This compulsion is introduced in the GST law. So this the concept of supply and the concept of recipient, there is supplier and recipient, it's a contract between two parties. Now, when it is a contract between two parties, I don't know why the logic of 180 days, etc. We should not get into that. That is what is my gut feeling. Of course, this provision was there introduced in the service tax when in the credit rules, the SENVAT rules for 3 months, the payment is not made and so on. But then effective to enforce that, it's so difficult. It's so difficult to enforce that particular provision. So where there are provisions which we cannot, which is difficult to enforce, and then issue a notice for collection, etc. I think we can do away with it in future, sir. We're looking at the future. We can do away with this 180 days, etc. Living between the supplier and the recipient. That's one suggestion which trade and industry is also telling us often and on. My suggestion. That's it. Nothing more, sir. Thank you very much.
Thank you, Rajendra ji, for your suggestion. I will just like to, this is a good suggestion from you. This has been coming from various sources, but I will like to give background of this provision. This was done by GST Council after a lot of deliberation in the beginning. And what was the purpose? This was done on the request of MSMEs, because there was a feeling in MSMEs that their payments are not being released by bigger vendors, bigger customers, and they are totally dependent on these bigger customers because their survival is on them only. And there should be some provision so that the recipient are forced to make payment to them in timely manner. So although MSME Act prescribes payment of such dues within a period of say 45 days or something, but council then took a view that at least from the perspective of availment of ITC in GST, we should make a provision to help MSME. And based on that, after, I think this issue has been discussed by council broadly, very intensely in 2 or 3 meetings. And there they took a view that it has to be there. And this provision needs to be there to help MSMEs so that they can get their amount within time. And the customer is forced to pay them amount in a time. Otherwise, your views, your suggestion is taken note of, and at appropriate time, whenever it is considered, it will be how suitable amendment we can consider. Thank you.
Rajesh sir, can I raise a query? This is Sushant Gupta.
I would like to Hello.
Yeah, sir. This is CS Sushant Gupta from Delhi.
Yes, Sushant. Before that, I would like to give the trade representative, Mr. Uday Pimprikar, He has been here as a representative of CIA. If you can raise the
Sure.
question.
Sure.
Sir.
Yeah, please. Mr. Uday, please. Mr. Uday Premplika, are you there? Any questions from your side?
Sir, no question, sir. One issue.
No issue. So I can take that you are giving your option to Mr. Sushant Gupta to raise a question. Mr. Sushant, please.
Thank you, sir. Thank you, sir. Sir, my question is, okay, what is the fate of GST tribunal? Like, is there any roadmap, or like we are expecting from the budget this time, there should be coming with a roadmap of formation of GST tribunal, since 4.5 years are passed. This is my only question, sir.
Thank you, Mr. Gupta. About GST tribunal, decision has to be taken by council. So we should hope that in the next GST council meeting, maybe this is decided, because there are issues pertaining to some legal issues pertaining to constitution of structure of council, structure of tribunal, and what should be the composition of the members of the tribunal and where they should be located. So council has to take a decision. I more than that, I cannot give any comment on that.
Okay, thank you, sir.
Sanjay, Mr. Sanjay, one issue.
Important question.
Sanjay,
Please, we cannot have a free hand. Sir, there's one question from Mr. Prashant Pandey from India Law Alliance. He was asking about clause 96 of the Finance Bill 2022 regarding retrospective jurisdiction. Sir,
Mr. Rajesh, I have some question.
hello.
Mr. Rajesh, I have some question.
Sir, may
I have some questions.
Ashok Mehta, sir.
Ashok Kanunga, Bangalore.
Yeah. Just, yeah, please, sir. You may raise a question.
Yes, sir.
It's already 5 o'clock, so just one more question after that and we end. Yeah, please don't embarrass me by requesting thereafter. Thank you.
So there is an amendment in section 50 bracket 3. Interest is levied only on the net cash balance. But in section 74 bracket 1, penalty can be levied, avail or utilize. So there is any relaxation by the government under section 74 bracket 1?
Thank you, Rishabhji, for your question. The amendment which has been done through finance bill is only in subsection 3 of section 50, which is the interest provision. So the amendment is being made that in respect of any wrongly availed ITC, which has been availed as well as utilized, interest will be levied. Okay, and not on that portion which has only been availed and not utilized. So interest portion is interest charging will be like this. As regards penalty under section 34 or 73 or 74, the provisions remains the same. So demand or penalty under 73 or 74 can be made under for availment or utilization, but the charging of interest even in under 73, 74 will be as per the provisions of section 50, which provides only for charging of interest only on that portion which has been availed as well as utilized.
Thank you, sir.
I think it will clarify that.
I have one question.
No, please, no further questions. There's one question I am raising regarding clause 96 of the finance bill. Sir, people would like to know the background and the legal sustainability, how this has been decided, both officers as well as many amongst the trade and professionals, if you would like to say so.
Lohani will take it, sir?
Sir?
Lohani, are you taking it now?
Yeah. So coming to clause 96, clause 96 is a validation clause for the purposes of customs. And this is a part of the Finance Act. It is not going into the Customs Act. It will remain in the Finance Act. What does this section do is to validate the action done by the customs officer. If we have to say who are these customs officers, these are the customs officers which are now mentioned in the amended section 3 of the Customs Act. So these officers may have done certain action in the past because they were assigned the work by the board or the Commissioner of Customs or Principal Commissioner of Customs before this act came into effect. However, these actions, say for example, certain issuance of certain show cause notices or issuance of certain other proceedings where these officers acted on a bona fide belief that they were authorized to do these actions and all, and notifications were also there. So section 96 validate action by any customs officer done before the Finance Act 2022 comes into effect, provided he has been notified and he has been assigned that function by the board under various notification. This validation clause says that the notification which were issued by, say for example, by the board under section 4 would deem to have been valid for any purpose of the Customs Act for it was intended. As a consequence, the action up to the date of enactment of this bill gets validated. However, if you see, there is an explanation also in the clause. This explanation clearly says that whatever action has been done by the such custom officer in past is validated, but any pending action which arises from the past act, say for example, certain investigation done, but now notification is to be issued, certain show cause notices have already been issued but are to be adjudicated, those actions will be performed as per the amended section, amended act, amended Customs Act. There, section 110 AA will come into effect, and the jurisdiction would be decided accordingly. So you may see that this is validation of action. This is not a retrospective legislation per se. It does not do any retrospective legislation. It says that on particular date, whatever has been done, it's okay. But moving forward, whatever has to be done, it has to be done under the amended act. So, so this is the kind of section, and this is the kind of mechanism which is there. As I mentioned to you, that the schema of Custom Act gets amended insofar as jurisdiction is concerned, so far as assigning the role and function is concerned. And in the light of that, this validation was required because in past certain infirmities were observed by the courts in the way Custom Act provided for assigning the role or assigning the function to the customs officer. So far as your argument, I mean Rajesh's question that there is some query or some desire to know as to the sustainability of such kind of action. So clearly, it is in good faith. This validation has been done. Has been done. If you see the total entire scheme has been done in the true spirit in which court have observed as to what we should have actually done. So the schema comes in that way. Then we feel that everything is as it should have been done, and therefore there should not be any issue about the sustainability or any validity of what has been done through this Finance Act.
Thank you, sir. Thank you for a very comprehensive reply to a question which had been in the minds of many who had sent me the WhatsApp messages and others. And sir, thank you for a very extensive question answer session. And with this, I have the difficult task of waking up the people from the trance and ending these animated discussions. I would request my colleague from DGTS Mumbai, Mr. Jitendra Patel, to propose a vote of thanks. Jitendra, please.
Thank you, DG sir. The CBIC has earned a name for taxpayer-friendly measures. There cannot be a better demonstration of the intention of the department to reach out to the taxpayer. And today, where the head of the department leads from the front. On behalf of the participants and DGTS, I take this opportunity to thank Chairman Sir, Shri Vivek Johari, for sparing the valuable time and for the comprehensive address made by him. I thank Sri Pramod Kumar Sir, Director General DGTS, for being the guiding light in the conduct of this webinar and for sparing his valuable time. I also thank Sri Sanjay Mangal Sir, Principal Commissioner GST Policy CBIC, and Sri GD Lohani Sir, Joint Secretary TRU CBIC. It is not common to hear first-hand account of tax proposal from such senior officers who are directly involved in the formulation of tax proposals. Thank you both, sirs, for a threadbare coverage of the issues and addressing the queries. I would also like to convey thanks to our partners in the trade, Sri Uday Pimprikar, Sri Bimal Jain,
Shri P. Rajendra Kumar, and the organizations they represent with CII, PhD Chamber of Commerce and Industry, and ICAI, respectively, for their contribution. Last, I would like to thank all our officers and participants whose active participation is the elixir which motivates us to come up with webinars after webinars. Thank you, one and all. Over to you, ADG sir, Dr. Rajesh Kumar Verma.
Thank you, Jitendra, and thank you, everyone. Sir, with your formal permission, I would declare this session as closed. In case Mangal sir and Lohani sir, you have any final words, sir? You may come up, sir. Otherwise, we end it here.
From my side, thank you so much, Rajesh, and it is so well organized, and it was a good experience. And there are a number of issues which are being raised, and of course, in time to come, I mean, in next few days, we anticipate that more questions will come when people go through the provisions which have been incorporated in the bill as well as in the notifications. We'll try to clear all those timely. Thank you very much.
Thank you, sir.
Thank you, Rajesh, and DGTS on my behalf also. It is a wonderfully organized webinar, and I thank all of the participants and the people who have raised the queries, which has enabled us to give some clarification. We have tried to note various queries which are there in chat box, and we will consider those suggestions wherever possible. So thanks for all the suggestions. Thank you, Rajesh.
Thank you, sir. With these final words, my thanks to all our senior members and also the trade representatives. With this, we declare the session is closed. We already exceeded almost 45-50 minutes. Thank you all for being patient participants and active participants. Thank you.
Thank you.
We are ending the meeting.
Thank you.